Welcome to Your Success Podcast. We give you actionable insight and stories behind real-life success wherever you go.
Welcome to Your Success Podcast. I'm Angelos, and today I'm joined by the tax wizard, Mr. Gordon McCaw. Welcome, Gordon.
Hi, Angelos.
Really pleased to have you back again. It's always a pleasure to have you here, and our audience love your tax advice. So really pleased to talk about a topic which many property investors may or may not be aware of, or if they are aware of, they may not know the full scope and advantages of incorporation. So, Gordon, can you just summarise, what does incorporation mean when it comes to the world of property?
Yeah, absolutely. Well, incorporation, it sounds like a grand term. The reality of it is that it's simply moving your business from a sole trader, someone who operates alone as an individual, into a corporate wrapper where you're protected from risk, from being sued. And mostly protected from risk, because often you still have to give personal guarantees and things like that. So although there are tax implications that can arise from moving from being an individual trading or being a partnership, say trading with your wife or other people, then the key part of it is it's moving into a limited company wrapper, new structure. Yeah. Okay,
so let's say you have a property investor and he's been trading for, 20 odd years in his sole name. All the mortgages are in his name. Yeah. Everything is running fine. Yeah. I think we have to cast our minds back to, 2016, when the then Chancellor, he decided to implement this thing called Section 24, which has been dubbed the Tenant Tax. So can you explain why that person of 20 years who's happy with his properties in his personal name would feel quite aggrieved by this new tax?
Yeah, absolutely. I can do. I'd also mention that lots of people were incorporating their property businesses before the new rules came out, for valuable reasons. A limited company does provide you with this limited liability protection. And also, even before the new rules came in, there was a certain point when it was more tax efficient to trade through a limited company, particularly if you had large debt. Companies pay tax at much lower rates than individuals. And if you think, let's say you earned £100 of income as an individual and you pay 40% tax, that leaves you with £60 left to be able to pay down debt, be able to pay down a mortgage. Whereas if you were a limited company and you generate £100 of income, you pay corporation tax at 20%, say, it's actually 19% now, falling to 17% soon, you can see that you've got a lot more money left over to be able to pay down debt quicker or acquire new property quicker and grow your portfolio. So there's always been really interesting reasons to think about moving into a new limited company structure, because it is more tax efficient. And limited liability is really interesting as well. If you don't have to give personal guarantees and you dramatically grow a property business, I think it's nice to be able to sleep easy at night and think that if interest rates go through the roof and your property business suddenly collapses, that your home is still protected. Or if you take out insurance and a tenant comes home some night and has been on the sauce, falls down the stairs and hurts themselves, it's good to know that if the insurance doesn't pay out, you forgot to renew the premium or whatever, then you've still got that limited liability protection, and you've got other assets which are protected, your other assets which you own personally are protected from that risk. Sometimes people have a mixture of properties in different companies. They might have two sets of debt. They might have one company which has got low risk properties, and they might have another company which has got high risk properties. And that's quite neat as well, because again, you can balance your risk and structure in different places. So regardless of tax, I think it's really worth bearing in mind that there's lots of really good practical benefits associated with trading through a limited company, as opposed to just doing it to secure a tax benefit. Going back to your question, got there in a roundabout way, the new rules basically said that higher rate taxpayers will be restricted in the tax relief that they can claim on interest payments. That's meant that for some property businesses, some people who run property businesses, when they when they've come to prepare their tax returns, they've actually been making a loss. Often people build up a portfolio with fairly low equity. They've borrowed whatever they can do to be able to make the business work, to maximise their income, to maximise the number of properties that they've got. And they've got fairly tight margins. And when you factor in the restriction on the tax relief, you have a few big repairs bills, a few big refurbishment projects, and before you know it, you don't actually have that much profit left, if anything at all. So it's actually been interesting, the change in the dynamic in the property market as a result of these new rules.
One of the things that when this was announced, the Chancellor at the time, he said, well, it was inferred, shall we say, that mortgage interest relief and claiming that back for your own private residential home was done away with a few decades ago. So now it's only fair that buy-to-let also has that relief taken away as well. But I don't think that's a fair like-for-like comparison, is it? Because at the end of the day, property investors are taking on a loan, debt, there's risk involved, they're borrowing against this thing, as opposed to it being a normal private residence. What are your thoughts on that?
I think it's interesting. It's an interesting point. I would say that although you don't get any tax relief at all on your home mortgage, the new rules are going to restrict it to 20% when they're fully implemented. So you'll still get 20% tax relief, just not 40%. So if anything, it's probably, it is higher rate taxpayers are the ones that are being punished here or being dissuaded from buying any more investment properties. I think it's clear that the government's policy is to have more properties available for people to be able to buy and open up the property market to more younger people who want to get on the property ladder. So I can understand what they're trying to achieve. I think that what the rules as many new tax rules do is they're often a sledgehammer to crack a nut, and they don't take account of a lot of different nuances, and they don't provide for things like the government hasn't really recognised that there are people who run property businesses. There are people who, in that role, are providing a valuable service. Not everyone can afford to buy a property, and I think that landlords who can afford to buy properties and then make them available for people to rent, so that they've got somewhere to live even in the short term, I think that's a really valuable service that they're playing, a really valuable role that they're playing in the economy.
Yeah. I'm seeing just going off on a slight tangent, I'm seeing a big shift across from, let's say, older retiring landlords, and this is a generalisation, I'm not saying everyone's the same, because it's absolutely not the case, but there tends to be a shift with younger, more clued up entrepreneurs, investors, etc., who have really high standards with their properties compared to older retiring landlords. So I think there's a real impetus now to provide the top accommodation standard you can, because the tenants are expecting that. And so I think, although the government would like to paint the landlord as this rogue landlord or whatever catches the headlines, a lot of people are very compliant and have very high standard properties for tenants, and I guess tenants have never had it better from that point of view because the standards are so high. So moving back to incorporation then, Gordon, how does one decide whether incorporation is right for them?
Well, there's a number of key factors, and I'd say that cost is one of the big ones. What is incorporation? How does it actually work? The mechanism for it. Essentially, you form a limited company. That's quite easy to do. And then you effectively transfer the properties which you own personally, you and your partner, and that could be business partner as well as life partner, then transfer the properties which you own to this limited company. That sounds fairly straightforward, but to be able to do it properly, there's a few key steps, and you've really got to think about it as if you're selling the properties to someone else, and also you're buying the properties from someone else, so you're a connected party here. Your limited company's buying the properties from you. That does mean conveyancing. It does mean taking out new mortgages a lot of the time, not always, but a lot of the time. And it does mean professional fees as well, getting your tax advice in place. Starting with the mortgage side of things, I think is really important, because lots of people are on very efficient, low interest rate loans, which are historical, and they've got great rates on those. if you go to most banks and you say, well, I'm going to transfer my mortgage, I want to transfer my mortgages to the new limited company, they'll say, well, you can't actually transfer them. What you've got to do is take out a new mortgage in the new limited company. And we need arrangement fees, and you can have a new loan, but unfortunately the interest rate's going to be much higher, and banks see it as an opportunity to move you onto different products.
And let's say you've got 20 odd properties in your personal name, there could be early repayment penalties, etc., etc.
Yeah.
I know before 2016, 2017, give or take, interest rates for limited companies were a lot higher than what they were for you in your own personal name. That has now reduced, so they are quite competitive. But there's a lot of factors to take into account. There's tax reasons, there's a certain threshold you want to be looking at. There's so many weird and wonderful things to take into account, and that's why people need to employ someone like yourself to give them a professional oversight, because this is a major change to any business.
Yeah, you're absolutely right. I think sometimes it's quite interesting if you've got a fairly newer property business. You can actually do a bit better through a limited company, but absolutely those historical arrangements, usually it was much, it will cost you money to remortgage and take out a new loan in a new limited company. Often there are benefits to it because you can have one consolidated loan, and it can actually mean that a bank is prepared to lend you a bit more than they might have done if you had the loans in your own name. And the other key thing for me is that you can move your debt from you personally into a limited company, as I've touched on before. And if you can get to a point where you don't have to have personal guarantees in place, and you've got your limited company, you're a shareholder in that limited company and a director, but you've got you've got properties in the limited company, you've got the debt in the limited companies. If something goes wrong in the property market, something dreadful, there's a lot of factors beyond your control. You can keep those issues away from your personal assets, from your home. And I think that's really valuable, especially for people who've done it for a long time and they're thinking, I need to wind down a bit now. I'd like to pass on the management of the properties to, let's say, an estate agent. And I'd just like to sit back and let the money roll in and retire, whatever. So I think that mortgage side is really interesting. It's really relevant because I'll talk about tax in a minute, but unless the numbers stack up from a refinancing perspective, it's not going to work. It's not going to work, and you can be stuck with what you've got. Moving on to the solicitor side of things, conveyancing fees. Absolutely, you've got to. You're pretty much selling the properties from yourself to your new limited company,
because it's a new legal entity, right? You can't just I'm the person who owns it, I'm the person who will own it. Yeah. What's the difference? Well, the two are very different and distinct from a legal point of view. So you have to do the conveyancing properly.
Yeah, you're absolutely right. And sometimes you look at it and you think, well, I'm just selling to myself. I don't need to do all the checks. It's just a waste of time. I've done it before. I know the property's fine. I'm not worried about it. But unfortunately, your conveyancer will tell you, well, you're not the only person with skin in the game. The bank has as well. And that means that we're obliged to do all the checks again so that the bank is safe and confident that the money that is going to lend you is going to be secured. So yeah, unfortunately, you've got to go through the whole conveyancing process, which is a bit of a drag. Final thing then, big thing is tax and accounts. Because you are selling or giving away properties from yourself to a separate legal entity, and that has capital gains tax and stamp duty land tax implications. Yeah, we've got the potential income tax rewards, but we've got to look at the capital gains tax and the stamp duty land tax. Taking capital gains tax first, if you've been lucky enough to have built up lots of capital growth within your portfolio, that is great, but it does mean that if you sell the properties, you pay capital gains tax. The government is good, they're good in a lot of ways, and they recognise that if you've got someone who wants to move their business, property business or otherwise, into a limited company, for commercial reasons, manage risk and everything else, then you should have a relief that allows you to deal with the capital gains tax side of things. So this relief is called incorporation relief, and you can move your property business or other business to a limited company and not pay any capital gains tax. It's subject to a few key rules. I won't go into all of them now, but the biggest one for me is that the capital gains on your portfolio have got to be capable of being absorbed by the equity in the business. So let's say you've built up equity of £250,000 and you've got capital gains of £300,000. because as you went along, you've drawn out some of the equity of the business as and when you can do to buy more properties. That would mean that there's a difference between equity and capital gains of £50,000 in that example. And you would then have to pay capital gains tax on that £50,000 difference if you were to incorporate. Most of the time, most people, the equity is big enough to absorb the capital gains, but not for everybody. And that's a really key point to check. Let's say you get through that. That's great. You can incorporate, not pay any capital gains tax. Most people are in that situation. And then you come to the stamp duty land tax. And it's a really big deal. It really is a big deal because I think that most of the portfolios I see, the numbers now with transferring a property to a limited company, it has to be done at market value. That's the deemed rule. There's a deemed market value rule. If you just transfer those properties to a limited company, you've got to pay the 3% surcharge, stamp duty land tax surcharge, plus normal stamp duty land tax rates. It's a huge number. You're not paying on growth, you're paying on market value. Fortunately, there's another great relief that's out there. It's a really quirky rule. There are some really weird rules within the tax legislation that sometimes don't make an awful lot of sense. But there is a rule that basically says if you've got a partnership and you transfer assets, property owned by the partnership to a limited company, and they're both in the same ownership, completely same ownership, and there's no stamp duty land tax to pay whatsoever on the movement. This can apply if you've got man and wife, or man, woman, and other partners involved. So yeah, there is a way through, no capital gains tax, no stamp duty land tax. That's great, and there's a way to guide people through that process, but as an accountant, tax advisor, there's a lot of risk there as well for someone like myself, and it's not as easy as just going, there you go, crack on. Here's a bit of paper and you don't need to worry about anything at all. All of these rules have depth and detail to them, and there is a cost involved with helping someone to navigate through those tax charges. I don't want to scare everyone off completely. I believe that whenever you crunch the numbers, you usually will be better off after 3-4 years maybe by moving into a limited company structure. But there is an upfront cost there that has to be absorbed.
And I think, listening to you, Gordon, one of the most important things is the planning element. You've got multi-disciplines here which all need to work together as a team with you. So you've got the legal, accounting, mortgage side.
Yeah.
And then it's all got to work between the three and yourself to make it all happen.
Yeah.
And then you've got to do a cost-benefit analysis to see whether the cost of moving across is actually going to be worth it.
Yeah.
So yeah, you need to get, whoever's listening to this and they have a significant portfolio and they're thinking of incorporating, they need to get professional advice.
They do, and it's interesting who project manages this sort of thing as well, because we don't have an estate agent there. Sometimes they help, sometimes they don't, but it usually falls on the accountant to do it. We've got the expertise, and what we would do for these sort of situations is I meet them all the time now because these rules are really starting to bite, and we will do a bit of a fact find out what properties someone's got, what their intentions and their plans are, find out about their business, what makes them tick, and then we will prepare a little report. It doesn't cost a huge amount of money, which basically says this is the cost to incorporate. We get information from a mortgage broker as well, pull it together in 2 or 3 pages and make it into a black and white decision. This is how many years it'll take you to balance and then be better off. Because otherwise, a lot of the time it's an emotional, theoretical sort of chat, and it's not. I think it needs to be colder than that. It needs to be colder based on the numbers, and it's got to be an emotionless business decision. And to be able to do that, you've got to invest a little bit of time and effort understanding the pros and cons, like you say. One of the other things that I think is really relevant is that the tax laws and rules are constantly evolving and changing. It does seem that, as I mentioned earlier, the government has got this thing about property investors. They don't seem to want new property investors entering the market, and they're trying to put people off with the stamp duty land tax rules and these new income tax restrictions if you're buying an investment property. And I feel like with a lot of tax changes, there's a group of people who or in a favourable system, and they can enjoy that and benefit from it. And then there's a new group of people coming along who might want to get into something, who are locked out of it, because a lot of the rule changes tend to say, okay, well, everybody who is past the post is fine, but anyone new coming in is locked out of it. And I feel like it's a bit like that with property incorporations. The stamp duty land tax exemption, the partnership thing, is quirky. It works. I've helped lots of people utilise that and move their businesses into a limited company. But I do think every time there's a budget, I think, what if the government decides we don't want anyone else making use of this exemption? What if we can just lock everyone who hasn't incorporated so far into these old structures, trading personally or as a partnership, and then everybody else who's already in a limited company is fine, and they're in that limited company structure and happily paying less tax than all the people who haven't incorporated. And I think then you've got two different groups of people, one of who is tax efficient, one of who is not, and as the government possibly continues to ramp up their attack on that group who's not, you could end up with, again, a distortion in the property market and different rents, one person being more profitable than another person, and that might have unfair implications and consequences. And sometimes people say to me, well, you could look at it from the other perspective. What if the government says, all the people who've incorporated and transferred into a limited company, why don't we, now we've got them trapped in that limited company structure, why don't we put up the corporation tax rates? Rather than being a 17% rate, we could have a 50% rate for property business owners.
So rather than, because if they did that across the board, there'd be outcry, right?
Yeah.
But they could potentially target specific SIC codes, right? SIC codes, and then anything to do with property, right? Let's take that right up.
Yeah.
So what are your thoughts on that, Gordon?
I don't think that there's many people who jump up and defend landlords. They're kind of they're one of those groups in society now that don't get a lot of support, and it seems to be that they're not always treated fairly. I don't know if the government recognises that there are people whose business and whose livelihood is being a landlord. There's maybe just a perception that we've got some people who've got second or third homes that they're renting out, and they're just using it as a second source of income, and it's completely distorting the property market. I think there might need to be a more grown-up approach from the government to tackling this.
That's another podcast altogether. I mean, it just seems at the moment everything seems to be very knee-jerk reaction, populism. Someone cries for the greedy landlord, right? And unfortunately, that stereotype is becoming more and more ingrained, which doesn't help the overall housing problem. You can shine the light on a specific segment, but the overall problem is that we're not building enough homes consistently over decades and decades. That's the issue. Targeting the people that are providing a great service for people is not the answer. But like you say, we need a grown-up discussion in Westminster, but that's a topic for another day.
But I do think the landlords are easy people to blame for the problem, aren't they? Yeah. Rather than, as you say, build more houses.
They're the new bankers, right? So the bankers in 2008, they were the big crims. Now it's landlords' time to take it, and hopefully, we'll grow up and move on, and both sides can sit down at the table and work out, how can we solve this problem? Because it is a real problem, this housing shortage. But attacking the people that provide this a solution is not the answer.
It is.
Right, Gordon. So just to wrap up, then, if someone at home is thinking, actually, incorporation could be for me, and they have a substantial portfolio, how do they get in contact with you?
Yeah, absolutely. Well, I'm based in Plymouth, and you can contact us on 01752 220979. I'd say call and have a chat if you're a landlord with a portfolio. Some of it sounds a bit scary, but bigger picture, there is often huge tax savings to be realised. I've only touched briefly on some of the tax benefits. There's others as well, and I'd say don't be the one left standing holding the baby after the rules have changed. Get some good advice now. Yeah.
All right, Gordon. Well, thank you so much for your time today. Really appreciate it. I do love speaking with you because you are
likewise
affectionately known as the tax wizard.
Just by you.
Just by me, yeah.
No, it's all. Thank you.
Cool. So we want to know your thoughts at home. Have you incorporated? Do you have any questions about incorporation? Please reach out at hello@yoursuccesspodcast, or get in touch on Facebook, YouTube, Twitter, the whole lot. We're out there. So thanks again, Gordon. And I've been Angelos, and I'll see you again on the next exciting episode of Your Success Podcast.
You have been listening to Your Success Podcast. Click subscribe for more incredible content. More details can be found at www.yoursuccesspodcast.com.